Focus. Ideate. Innovate. Enable.
The year 1984. The setting, Columbia Business School. It was here in his speech that Warren Buffett revealed his new philosophy for investing. And he also predicted that no one would listen to his advice. Hello and welcome. You're watching CNBC TV 18 Crack the Code, presented by BSE, a brand new series that aims to educate investors about making informed decisions. So building on what Benjamin Graham said in the 30s, the secret that Warren Buffett revealed 30 years ago today forms the very basis of value investing. But let me not do all the talking. Let me actually invite my two experts. We have Nipun Mehta of Blue Ocean Capital and PB Subramaniam of Subramani. Gentlemen, thank you so much for being a part of this show. And I actually want to begin with you, Nipun, because you have so much experience in actually directly dealing with clients. Because when you talk about value investing, so you have the fundamentals should be strong of a company. Management should be of good quality. There should be consistency in earnings. I mean, there's so many parameters to look at, and yet very often there's so much that's left unsaid between the lines. Is that why retail investors actually find it so difficult to transition to being a value investor?
This is one style of investing which very clearly looks at a lot of fundamental aspects. So by definition, it is the price gap or a discount that's available from fundamental or intrinsic value. So beside, of course, the quality of management and the fact that the company or the industry is doing well, one needs to look at several other parameters like, let's say, the price to earnings ratio, the price to book ratio. You could have dividend yield as one of the other parameters that is there. Is there a specific event that has happened because of which the price has fallen, or is it a discount to its intrinsic value? So a lot of these parameters become important. If you look at, let's say, cement as a space, maybe 2 years back, demand-supply mismatch was there. Virtually all companies were quoted at relatively low price to earning ratios. The price to book was obviously very low. But as an opportunity, the cement space would obviously always start growing, or the demand would start picking up the moment there's spending on infrastructure or real estate. Today, when there has been a significantly higher demand that's come in, you are seeing completely different valuations as compared to what they were maybe a couple of years back.
Yeah, in recent memory, that's a good example for sure. But Subra, tell me, what are the parameters that you look at? And in India, is it really so easy for a value investor to find quality stocks?
The best Indian companies in terms of value investing, in terms of PE ratio and PB ratio, etc., you find in the PSU space. And PSU space, talking of management quality, seems to be a joke, because all of them are available at very low PEs, and you could just wipe out the dividend yield. For example, at 145 rupees, say 2 years ago, NTPC looked like a very good value investment because it was giving you a 5 rupee dividend and things like that. So it looked like a good dividend yield. It had a good price to book ratio, and the accounts were fairly clean. However, you lost the whole value when the price dropped to 115. So you captured it for 5 rupees of dividend yield. So next 6 years dividend was wiped out in the mark-to-market losses. So the quality of balance sheets in India is not so simple. You find companies available at a market cap which is less than the so-called cash on hand. And value investing happens at the lower end. You cannot expect value investing to happen at the higher end of the shares. So how are you going to pick them up?
You've raised a good point, which is that value investing is done at the lower end, right? So Benjamin Graham thought it should be 1/3 the intrinsic value. What should it actually be? I mean, in today's scenario, what should a retail investor be looking for?
I think anywhere from 1/3 to half is an attractive price that comes in, because a lot of aspects to this are not necessarily quantitative. There are also qualitative aspects. So if there is a good management, how's the management using the cash? Is what you also start whenever the price has fallen. Is it using the cash for buybacks? Is it using the cash for incremental capex that is there? Diamond companies, for example, there are companies which were quoted at whatever, let's say 50 rupees at a particular point in time, or 60 rupees at a particular. Today some of them are at 2 rupees and 3 rupees. There's a significant erosion. Is there value in it? I would say no. So because there's a fundamental change as far as the industry itself is concerned.
So you should know whether it's a temporary setback, whether the stock hasn't been discovered, or whether it's been discovered and discarded. So either way, you should know what you're looking at. But a good case in point is Maruti. You'd remember when they announced their plans for the Gujarat plant, the stock fell, and today brokerages are actually giving targets as high as 6,000 rupees. But this is a story that can also be told another way, which is, say, a Amtech Auto. Once they were hailed for being this aggressive M&A play, and then it's the same thing which actually caused their downfall because they had so much debt. So how does a person actually know whether it's going to be a temporary setback, whether it's a stock that they just shouldn't touch? What would you look at to judge that stock?
See, largely you will have to go by market cap, because when the market cap of a company is extremely low, say around 100 crores or 125 crores, it's very scary for a small guy to look at it as value investing. It's okay for a big investor who has the ability to sit out and hold 10% and 20%, walk into the board meeting and say do this and do that is different. And a guy holding 1,000 shares or even 10,000 shares, he doesn't have that kind of control over what's happening. So he will have to look at a consistent dividend yield. I don't know, shares like Rane Madras used to be available at a 7% dividend yield, and it used to be at 100 rupees. But it was a bad share in terms of quantity. Even if you had to buy 5,000 shares, it would take you maybe 20 days to buy it. It was very worrisome. Will I be able to ever get rid of 5,000 shares? Buying is easy, but will I be able to get rid of it? So you're worried. And then suddenly you keep watching and it jumps up in value. Rico Auto was another example. It used to give you, till about 2 weeks ago, it used to give you a 6% dividend yield.
Okay, so tell me one thing. It's all very well that a person should go out and be researching all of this, but we'll have to admit it's not very easy for a person who's not in the market every day. Is it okay if a person wants to just go out and mirror the investment or the portfolio of a market veteran? Or should they just learn from their styles and shouldn't actually be mirroring the exact investments that they've made?
Look, all the data and all the articles and all the books that you have today on any kind of investing is US based investing. US was in a growth trajectory right from say 1900s till today. So whatever was true there, we just try and cut and paste. But what Graham said may not hold true today even in the American market. Secondly, Indian mutual funds are never true to label. There is perhaps one fund which is a value fund which is true to label. He will actually pick up a value stock, and the minute the value capture is over, he'll sell it off. I see only one fund house, one fund doing that. And so whom will you copy and what will you copy?
One aspect is the stock selection, right? What do you invest in and when? The other aspect is how long do you hold, or do you need to average? Do you need to exit? Is there really a strategy in that for the value investor, or do they, once invested, sit for the long term?
Well, when you enter at a particular price, you never know whether that's going to be the bottom or the max fall or price discounting to its intrinsic value. So the ideal situation for an investor would be to keep buying intermittently a certain percentage of what he would wanted to buy. The way you have SIPs for mutual funds, you could do that similarly, as long as you have conviction on the company and the stock. For an exit, I think the exit doesn't come for value investing in a day or in a month. One needs to have a fair amount of patience for the actual price to move based on the change in fundamentals of the company, circumstances of the company, cash flows of the company, how the investments have happened, and a lot of that. But typically, if you go by Warren Buffett's style of investing, he typically has rarely sold. Most investors in India who are doing value investing won't necessarily follow that style. But as long as you have conviction on the company having a sustainable business, I think you can hold it for not necessarily perpetuity, but a fairly longer duration.
All right, so research well. Don't get swayed by systematic risks. Stay invested for the long term. So these are some of the key learnings really for a value investor. Let's take a very quick break. When we come back, we're actually going to do the actual hard work. We'll talk about how you should be reading and analyzing or interpreting the numbers or the math behind the quality of a stock. Stay tuned. We'll be back in just a bit. Welcome back. You're watching CNBC TV 18 Crack the Code, presented by BSE. We're in conversation with Nipun Mehta of Blue Ocean Capital and PV Subramaniam of Subramani. So we've discussed the philosophy and the ideals behind value investing, but let's get down to the hard math now. Subra, if all things being equal, right? You have the ROE, the ROCE, I mean, you name it, okay? You've analyzed all the ratios. All things being equal between two stocks, what would be your tiebreaker? I mean, what's the most important ratio?
That's really difficult because you don't want to invest in an industry which is going to get wiped out.
Okay.
A few years ago, if you had invested in Kodak, you would have been wiped out because, what happened with technology. So that is one thing which is going to change, and I think value investing is going to get more and more difficult because value investing gets captured over longer periods of time, and today industries have a shorter life.
Sure.
So you will have to look at an industry which is younger or an industry which can never go out of fashion, like say cement or sugar or steel. This can't go out of fashion. So when the prices are low, this is again trying to capture value when the commodity and combining it with the commodity cycle. So at a point in time, sugar stocks will be available at a ridiculously low price, not because of anything else, but because there's a glut in the world market about sugar. So at that time, it's a good time to be picking up a sugar stock and knowing that over 2, 3, 5 years, it's going to go up. So there can't be, I don't think there can be one answer which says, oh, this is the way how I'll pick it, because some good management far away in east of India or south of India, which is not captured by our Western media, could be a better share to buy than a company headquartered here which knows how to be savvy with the media. So it's very difficult to pick up one thing. But yes, rising ROC, rising RONW, increasing market share, improving, if all those things are there, then why choose between the two? Pick up both.
Yeah, so basically it's just consistency in the metrics over a period of time.
Right.
Okay, Nipun, let me ask you this, that a low PE ratio is normally considered a good buy, right, for a value investor. I mean, you've said that throughout. Could it be that that hidden gem could turn out to be a landmine?
When you look at low PE, it could be for various reasons. It could be for conservative management. It could be, like in a lot of PSU companies, fear of disinvestment happening at any given point in time, despite high dividend yield. Typically, when you see managements undergo a shift, undergo a change, that's when you start generally seeing the PE ratios undergo a change. Given the constant as far as the industry metrics is concerned, take a case of something like probably an India Cement, just as something as an example, where the management had issues related to a mix of businesses, probably not focusing on the cement business. It was focusing on cricket and a lot of other activities. All of a sudden, you have a forced change in terms of greater focus on the cement business itself, and you see a sudden shift, sudden change as far as performance is concerned, as far as the various ratios are concerned. But yes, I think it's important to know that simply because the PE ratio is low does not make it a value investing proposition. There could be various other reasons.
Fair enough. Subra, let me come to you on this, because you've mentioned to me many times how important return on equity is in terms of a parameter for a stock. If the ROE is indeed high, would you be willing to pay a higher price to buy that stock? I mean, is that also one of the, does that fall into the core principles of value investing?
Actually, if you ask me, the PE ratio is one of the easiest to calculate and one of the toughest to understand. So a PE is a function of, does the common man or do the investors trust the management? Do they have a consistent dividend paying ratio? Do they, a lot of these things go into PE ratio. So you look at the PE ratio and say, will I touch it at all or will I not touch it at all? If the PE is in the 40s and things like that, you don't even want to look at it. But in the PE in the 20s is a good cue for you to have a look at it and then say, oh, can I get something lower and buy? So using the PE as the sole indicator seems to be very difficult. You have to take it with a lot of other things. Like I said, ROCE, ROE, if the company is able to borrow funds at say 8, 10%, 11% and able to get certain 12 and 14% return on its capital employed, I wouldn't worry too much about the PE, especially in a market which is increasing. But if it's a steel business, which is a commodity business internationally, you are really worried about paying a high PE because you don't know whether there will be growth, whether there will be margins. But if it is something which is like you pick up a hospital industry or things like that, I mean, the demand is just unlimited. It's just happening. So paying a little higher PE, because you should also be looking at PEG, how much of growth is also happening. So paying a little higher PE for a company growing at 30%, you don't mind paying a higher PE.
All right. My next question is actually to both of you, because we've actually, over the last few months seen a slew of QIPs. There are so many rights issues. How does a value investor, especially a retail investor, read, these exercises to raise money? Is that, even a QIP, is that better than raising debt?
At what price the QIP is done becomes critical. You are at a low in a market, and there is a QIP issue that could be there, which could dilute equity significantly, which is obviously EPS dilutive, and you're likely to see the positive impact of the utilization of funds, which could be in the form of capex or whatever it is. The impact of it could be maybe a few years down the line, which would mean that the EPS dilution would be for a fairly long period of time. So at what price and what stage in the market is the QIP done obviously becomes critical. QIP / rights issue. What's the debt equity ratio is again something that's critical. So you could have had a QIP simply because your debt equity ratio is very high, and you wanted to reduce that, and there's very limited immediate possibility of repayment of debt that could happen through internal accruals, and which is the reason you probably could be raising equity. So various reasons.
Subra, let me actually take this answer forward. Nipul mentioned how important EPS should actually be in terms of monitoring your stock holding, right? At the end of the day, is EPS all that matters? For example, if a company, say, has a boost of other income, right? Operationally, maybe not doing so well. What would you look at in this case?
No, I would definitely look at the operating cash flow. Because it's not that if the company has invested the money, let's say the company has invested money in debt funds and interest rates fall, and therefore obviously his EPS is going to go up because he might book some profits in that. I have not given him money to invest in debt funds. That's something which I can do directly. But from his operations, if his money is coming up, and actually I wouldn't be too much worried if he's going to put up in money in a new plant, and that plant is going to contribute after 2-3 years. I'm happy to give him a higher P, because I know the EPS is going to catch up in a couple of years. So that doesn't bother me so much. One single number never bothers me. It's always taken in conjunction with other numbers that you decide. So whether he takes debt or whether he takes equity, if he already has too much of debt, the fact that he's taking equity makes sense, because he's consolidating his position and doing that.
Well, that's fair enough, actually, because there is no one objective way to look at any of it, right? Everything should be looked at in a case-by-case basis. All right, but on that note, we need to take a very quick break. We'll come back in just a bit, and when we come back, we'll talk about whether or not there's a case to be made for diversification in a value investor's portfolio. All of that is lined up next. Stay tuned. Welcome back. You're watching CNBC TV 18 Crack the Code, presented by BSE. We're in conversation with Nipul Mehta of Blue Ocean Capital and PV Subramaniam of Supramoney. So, gentlemen, we've discussed the philosophy behind value investing. We've done the hard math. Now I want to actually get to some of the critics of value investing, one of which is that a lot of value investors actually end up staying out for parts of the bull run because they don't get their entry point. Is that something that you've actually seen in practice?
I won't entirely say that in bull runs, value investors completely miss out on very long bull runs that could be there. They could participate in the existing investments that are there. But even within the listed stocks where the investments are not there, there could be opportunities that come about, like what happened, let's say, in the case of Maruti, when the markets were actually at a bull run, and that announcement came about, and you saw the price getting eroded by close to about 20-25%. So there would be always opportunities that could come about even in a long bull run.
Yeah, that's true, but those are few and far between. But anyway, this actually brings me to my next question, Subra, which is of diversification, right? Maybe you're not getting a stock which is available at the price that you want, or for that matter, you may have fresh capital to deploy and not a new stock to focus on. Do you then put that money in the stocks which have already given you good returns?
Yeah, actually, the retail investor doesn't really sit down and say, this is my value portfolio or this is my growth portfolio. He has a combination. So sometimes he is a value investor, and sometimes when he can't find, he would still look for trading opportunities, or he would even look at growth, or he would look at some IPO which he could buy at that price. So nobody gets stuck with that. So I know I bought Apollo Hospital when it was subpar, okay, it was 9 rupees and I bought it for dividend, and at 150 rupees I thought the value was fully captured, so I sold out. Now it's at 1400 or 1300. So it does happen. You lose out on something and you don't realize how the market is capturing more and more value. Like none of these companies, Asian Paints or HDFC or Colgate or P&G, they were never cheap, but they all have added value. Let's face it, all investing is value investing. Weighting is a very important thing. It's very important in value investing at least.
Yeah, enough and more people have actually called cash an asset class by itself, right? So that isn't much of a problem. But just to wrap it up, Subra, any last thoughts, any words of wisdom for the value investor out there?
Yeah, the value investor needs to learn a lot of meditation. He needs to know how to sit tight over long periods of time. It's not very difficult, especially if you're getting good dividend yields. In this market, you can still pick up stocks which are giving you 5-6% dividend yield in a country where the bank deposit is at 7% taxable. Here you're getting 5-6% tax-free. What more do you want? Just learn to sit tight.
Yeah, and my just 2 bits right at the end is to buy businesses that you love and understand and not just stocks. Nipun, Subra, thanks very much for being a part of this show, and it was really a pleasure speaking and learning from you. Thanks very much indeed.
Focus. Ideate. Innovate. Enable.